Guys, I have created a tool that I call Optifolio, and this can really revolutionize the way you invest. My tool, Optifolio, basically it runs potentially thousands of Monte Carlo simulations. I'll tell you what this is, and will tell you exactly how much you should allocate to a certain investment, considering these thousands of simulations. So you see, when you invest in the market, in the stock market or crypto, it's hard to do experimentation. First, because you cannot put stocks in a lab, like just like you put, I don't know, bacteria or chemical products or like quantum mechanics. Those things you can test in the market, so you can repeat many experiments. But in the stock market, in crypto, in investments, you cannot repeat many investments because first you have time constraints. Because if you want to run an experiment on like, oh, how will these investments do in 10 years? It's very hard to repeat the same investment. And also, it's your money, so you cannot just play around doing these experiments. For that reason, we do Monte Carlo simulations. So these Monte Carlo simulations give you thousands or 1,000 different possibilities of what can happen in the market to your investments, considering the historical data. And this is what I'm going to show you in my tool. So let's get straight into it. And by the way, this tool is part of my leveraged ETF course. I'm a big proponent of using a little bit of leverage to increase your risk adjusted returns, to maximize your returns over the long term. You should use a little bit of leverage, okay? In this tool, it really shows you how much leverage, how much you should allocate to a certain investment, considering the simulations that we are going to run. So you might be watching this video as part of my leverage ETF course, or if you are watching it somewhere else or on social media, check my Be Limitless community and the leveraged ETF course. Okay, so let's get straight into it. And I'm going to do now a tutorial to show you how to use the tool. Okay, first you need to select an asset. You can select between like some indices, stocks, cryptocurrencies. But for now, let's just do S&P 500. You can select the historical data that you can use to do the simulation. And you select now investment parameters, initial investment, and the investment time horizon that you want to simulate. Let's do 10 years. Now, simulation parameters, you have here the Monte Carlo simulation, geometric Brownian motion, Garch model, Markov chain, and Feynman path integral. These are very advanced models. I really like quantitative analysis and quant finance, so I have decided to add some of these models here. And I'm so serious about it. I even read a book about the Feynman path integral, which is how to find the path, how to predict the path of quantum particles in quantum mechanics, and you can also use it for finance. Anyway, it's too geeky. I'm going now for this demo. I'm just going to show you the Monte Carlo simulation. Let's do like 1,000 simulations here. You can select the risk-free rate. Let's leave it at 2%. And you have here the leverage parameters, which for now we leave manual at 1x to simulate just a regular investment. Okay, let's go ahead and click run simulation. And what's going to happen? Wow, amazing. So we have here, we have invested $10,000 and we have made 1,000 different simulations, have here 1,000 different simulations. And the median return of these simulations was 13%. We have 15 simulations that are below our initial investment, so it's not guaranteed that we will make money over the next 10 years, according to according to this Monte Carlo simulation. We have 985 paths above initial investment and 480 above benchmark, so above the S&P 500 historical return. And here you can see the different simulations. You have here the distribution, the statistical distribution of our returns. And we have also this 5% is the fifth lower percentile, 95th percentile. We have the median, the mean. So it's you have here a lot of information, right? You can understand, okay, if I invest $10,000, it will probably be one of these results in the future. So it's not guaranteed that it will be, people usually talk about like, right, oh, on average, yes, on average, you'll get 10, 13%, whatever from the stock market. But there are worlds, there are scenarios where you'll get way less. There are also scenarios where you'll get way more. So people often talk about, oh, stock market returns on average 10%. But the reality is that it never returns 10%. That's an average. It usually returns 15, 20, 30, 40%, or zero. -5, -10, -20%. Okay. So the 10% that usually people talk about is an average. And here you can visualize that, right? Because in this chart, you have everything except the average, right? We have many, many, many scenarios, and your investments will be falling into one of these scenarios. Now, simulation details, you have here, okay, the historical returns of the market, and then the market starts from here, and you have all these different scenarios here. It's one of the possibilities. You can also find here some statistical data, okay, median, maximum value, minimum value, the different percentiles, compound annual growth, the drawdowns, the median drawdown, okay, is 29%. So it means that most likely your investments, if you just invest in the regular S&P 500, it might go down close to 30%. So it's not too little, but this is just the reality of investing. And then now we have here the Kelly analysis. This is one of my favorite parts of this simulator because it tells us what's the optimal allocation or the optimal leverage to invest in the S&P 500. And you can see here that the optimal leverage for the S&P 500 according to these simulations will be around 4.22x, okay? Of course, this doesn't have into account that we might have a crash tomorrow, okay? So if you want to be safe, you should use fractional Kelly. So you should not go full Kelly and invest with 4x leverage. We should probably go like fractional Kelly, half Kelly, which you can see here is around 2x leverage. Okay, actually you have it here, 1.93x leverage. So this is more like a safer way of investing. You can also explore the tool. You have here different use cases. I wrote about the different use cases and also about the models that are made available in this tool. Okay, this is a very, very interesting thing. Now, I want to show you, okay, what will happen if you use a bit of leverage, okay? So let's say if you have invested, this is a normal simulation with 1x leverage, okay? You have here 1x. And you transform $10,000 into $34,000 over a period of 10 years. Okay, not bad. But what if you change here from manual to fractional Kelly and we do fractional Kelly 0.5? So it will probably give you that 2x leverage. We only use fractional Kelly to keep it more safer, and we run simulation. And now instead of $30,000 at the end of 10 years, we have $81,000. So we have used that 1.93, almost 2x leverage, and our median annual return went from 13% to 23%. Okay, so this is very cool. And they have some paths that are below initial investment, 19, and you have here all the results, and this is really, really great data. But how far can we go with this leverage? Okay, so imagine now I'm going to put manual and I want to do, wow, I want to go wild. I want to do 5x leverage, okay? Every time you do a new simulation, you need to click reset cache. Here, if you put 5x leverage, what happens to our investment? So I click run simulation, and now we have median annual return 35%, median final value $200,000, but the risk has increased significantly. Now, 137 paths are below our initial investment. So 13% probability that at the end of 10 years, you're actually losing money, not making money. So we actually have increased the risk significantly. And you even have one path that gave you major loss. You lost over 99%, okay? So this will be like very, very wild leverage. So probably the ideal leverage will be like around 2x or even up to 3x. Let's simulate here the 3x leverage. Reset, run simulation, and the 3x simulation, it's pretty good. But remember, now we also have here 54 paths out of the 1,000 that are below initial investments. But the returns are quite amazing. You transform $10,000 into $140,000. Not bad, right? You can also select, if you want, you can select full Kelly Criterion, reset, simulate. This is the to give you the optimal risk-adjusted returns. Okay, it will be 3.85x leverage, transform $10,000 into $196,000 in only 10 years. But you increase the risk. There is a 6.9% probability that you will lose money. Okay, So I will never do this with like a very large amount of savings. Um, and different assets will have like different uh, curves of like this one, right? So let's say now I select Nasdaq 100 and I put like more data, I put like 40 years. I don't know what's the maximum data that we have on Nasdaq, but let's run the simulation. Let's run the simulation. And here it's using for the Kelly criterion, it tells us the optimal leverage is 2% for Nasdaq because why? Nasdaq is a bit more volatile. And our Kelly analysis, it shows that, yeah, you can see here the optimal leverage maximum 2.4. Okay. So Nasdaq, because it's a bit more volatile, the S&P 500, then the S&P 500 should use a bit less leverage. This is actually aligned with the literature and with the uh, research papers that were done in the past that compared like 100 years of data. And in the S&P 500, you can leverage like up to 3x, up to always less than that. When I say up to 3x, it doesn't mean that you should leverage 3x. You should leverage always less than 3x. And Nasdaq, you can leverage maybe up to 2x leverage, okay? Because if you leverage more than that, you will for sure lose money because like these leveraging will increase your returns, but will also increase the volatility of your portfolio, and that volatility will eat up your returns. So it's not worth it. Oh, and by the way, I also want to show you here like what happens if you select something very very volatile. Let's put here. Okay, let's put Bitcoin. Okay, Bitcoin, and you have like put 10 years of data, and what happens if you like do, let's put here manual, and do like a 5x leverage on Bitcoin? Some people do this in real life, right? What would happen? Okay, let's run simulation. And if you leverage Bitcoin 5x, your final median value is zero. In the median annual return minus 67%. And most likely you will lose money. You will blow up your account. So you get like a very weird chart here. I don't know even what this is. If you do, let's say something more like a bit more normal, 2.5 leverage, reset, run simulation. Wow, you could have a lot of money. You could have transformed $10,000 into $1.5 million. But there is also a high likelihood that will go bust. You can have total major loss. Anyway, you can play around with these, have many different assets. You can select stocks, you can select like Tesla, Nvidia, Apple, and play around and see what's the optimal leverage. Now, finally, I want to show you my Kelly game. I have added a Kelly game. So you can select the type of asset, index, stocks, and so on. I'm going to leave here the S&P 500. You can select simulation method, the bootstrap or market chain. Let's initialize game. And basically, every time you click advanced week, you are investing for one more week. Okay. And now this is just simulating a normal portfolio with 1x leverage. Okay. And it's going down, it's going up, and so on. And now what you can do is to play around with the leverage. Okay, let's simulate what if in this moment in the market now I want to do with a 2, I want to increase my leverage to 2. Okay, so 2, it says it's a respectable conservatism, 0.5 optimal Kelly. Yes, smart money territory. Okay, good. Advanced week, and what happens, you start to see here that we have the benchmark and our portfolio leverage. Because when the benchmark, in this case the S&P 500, when it goes down, our leverage goes down even more. When it goes up even more, right? So we can simulate here what will happen week over week over week by using a 2x leverage. Total simulated. This is like not a real historical data. This is just simulated future data. What will happen to your portfolio using, in this case, we are using that 2.1 leverage. Well, when it goes up a lot. When it goes down, as you can see here, it also goes down a lot, right? But over the long term, the reality is that you will get better returns. Okay. What happens if we do use a lot of leverage? Let's dial up this to 5x. Okay. Leverage is really like the speed that you use on the highway. If you are going at 120 kilometers per hour, I don't know how much is that in miles, sorry, to American guys watching this, but 120 kilometers per hour, you get faster to your destination and you get there like quite safely, right? But if you leverage your speed to 200 kilometers per hour, 250, you arrive much faster, but the risks are not worth it, right? It's the same as using leverage of like 5x here, right? So what's happening? What's going to happen if I advance weeks? Whoa, if it drops really hard, really hard. If it goes up, it can go up also really hard. But now we are counting on like really luck and not really on. This is not a respectable investment strategy using the 5x leverage. You see, our portfolio now is so much volatile, is all over the place with this 5x leverage. It can go well. Now it seems that it's going well, but I don't know if I continue playing this week over week over week, it might also blow up my account because 5x leverage is a bit too much. Again, in this case, it seems that this simulation is being quite friendly for us, but cannot trust it that will go well in reality forever. Okay, so these are the things that you can find in this portfolio simulator. I hope you have enjoyed this video. You can find the link for the tool in the resources section or in the description of the video. Play around with the tool, simulate your investments, simulate different levels of leverage to understand what works best to maximize your returns, what works best according to your risk profile, and let me know your feedback. All right, I'll see you in the next one.